and I want to walk you through conventional loans and when they actually make sense versus FHA. Because the answer changed a few years ago, and most people don't even know it yet. A conventional loan is a loan that is not backed by the federal government. Conventional loans are purchased by Fannie Mae and Freddie Mac, and they do conform to Fannie Mae and Freddie Mac's approval guidelines, but they're not insured by the government like FHA, VA, and USDA loans are. With a conventional loan, you can actually put 3% down as a first-time home buyer. Otherwise, you can put as little as 5% down. But if you put less than 20% down, you will pay PMI monthly, which is private mortgage insurance, until you reach 20% in equity. And that's an important point that we will circle back to. The real question is always FHA versus conventional. And the answer to that question almost entirely depends on your credit score, with a few exceptions. The FHA back in 2023 dramatically reduced their mortgage insurance rates. It used to be about a 660 or 680 credit score. If you were below that, FHA started to make more sense. But now, because FHA's mortgage insurance rates are so much lower, that bright line is really more like a 720 credit score. So if you're putting 3% or 3.5% with FHA, if you're putting a minimal down payment as a first-time home buyer, with an FHA loan, if you have a 720 score, a conventional loan starts to be less expensive. But if you're at a 700 score, the FHA loan, it might be the one that you're going to choose, right? Because above a 720 score, conventional PMI becomes low enough that conventional wins on total cost, usually by a noticeable margin. And again, that PMI goes away when you reach 20% in equity with a conventional loan. With an FHA loan, if you're below 720, you often have the lower monthly payment because FHA charges the same mortgage insurance rate regardless of your credit score. So if you have a 640 credit score or a 780 credit score, with FHA, it's the same mortgage insurance rate. But that's not how conventional works, and that's why you see that difference. The trade-off with FHA is that if you put less than 10% down, the mortgage insurance never drops off on its own. You have to pay off the mortgage or refinance out of it eventually. That costs money, and it's not a deal breaker, but it's real and it's worth knowing going in. FHA also charges an upfront mortgage insurance premium, which adds a few $1,000s to your loan amount. And so, you might have a lower monthly payment and it might be the better idea to do the FHA loan, but it's important to know about some of those extra costs. So if your score is above a 720 and your loan officer is pushing FHA without showing you the conventional comparison, ask why. Okay, there are some exceptions to the rule, but you would want to know why and have them run both side by side. Full payment, 5-year cost, right? What is the better mortgage in my situation? And if you're wondering what that comparison looks like for you, I'd be happy to walk you through it. Feel free to schedule a discovery call at whatever time is most convenient for you. Thank you.